Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we separated out again and we did something on the geopolitics, the food rates, how are those all kind of merging together, especially as we look into 2022, which doesn't look as good as 2021 did. And what does that mean with raising rates, food prices, energy prices, where they are. But now that we've gone through that and did that special segment, we wanted to look at what are some of the key things that are happening within the U.S. So here, we're going to have 3 segments on the U.S. this time because we want to look at U.S. infrastructure. Now that the bill is passed, we know what's in it. Leading economic indicators in segment 1. Then we're going to go through wages and retail sales. As we said, we thought October was going to be pretty good, that we saw some of that spending that normally happens in November pulled into October, but how is November going so far? Is it something where we'll be fairly stable, or are we going to see a decline? It's going to be a matter of, what are those leading indicators saying? What are wages doing? Prices? And then we're going to go further into wages and retail sales in the next one, and then look at employment and housing. What is happening on the employment level? How people are quitting? What do jobs look like? And then what does the housing market look like as some prices go up in some areas, especially on the rent side? And then European data was fairly mixed, but inflation continues to be a grind higher. And then we're going to round it out with a view of Chinese data, which was fairly mixed, but problems are still within that entity that we want to look at what the problems are, and then go deeper into what's happening in India and Japan at this point, now that we have some additional numbers. So with that being said, we're going to go a little bit deeper into the transportation investments that are going to be made over $550 billion in new infrastructure spending. And this is, again, the piece that's part of the $1.2 trillion bipartisan infrastructure bill, which includes about $550 billion in new spending over 5 years. So the different infrastructure provisions within the new spending are represented here based on the different backdrops, with roads and bridges, public transport, passenger and freight rail, including Amtrak, airports, ports and waterways. So all of those things are important in terms of where they are, but then also the national water infrastructure, making sure that there's the ports, dredging, making sure that things are up to standard, energy and power infrastructure, which is where we're focusing on in terms of what my private equity fund is looking to do, in terms of being a solution for that, and then also increasing the availability of internet across the country on the broadband side, and then the resiliency infrastructure and some of this is going obviously into EV charging stations, supercharging. And again, these are some of the pressure points, as some of this is going into places that are a bit of filler or pork, but there is some real spending being done in places that need it most. The problem is it's still not really enough for the areas. And I wish we could spend more on roads and bridges, just based on how things have collapsed around the country, if you've ever driven, especially on 95. So again, these are things that are going to be worked on, and we do need to continue to spend, but continue to spend in a measured way. And what does that measured way look like? Which, as I said from the very beginning, the March deal I didn't think was really necessary. It was really, if we did this one in March, then you would create jobs, you would create other things that need to be done, and you would pay people through some of these work programs, given how important they are, and not just giving people straight cash. But again, that's just one man's view of how this should have been played out. But when we look at where the shipments are, what is happening on the Cass Freight side, looking back in October and how we've looked into November, we talk about this every week on the EIA segment 2 side of the show. So on a seasonally adjusted basis, the shipment index recovered 2.8% month over month in October, after falling 4.9% in September due to Hurricane Ida. The 2-year stack reversed to a 3.2% increase from a 1.3% drop in September. Still very strong. Freight volumes remain capacity constrained, as shown by declining rail volumes and the ongoing backlog of container ships. Container ships are starting to get a little bit better, but you still have this huge issue on not only just the rail side, but also the trucking side. And then a pickup in automotive volumes likely helped, but that's again going to be a bit a one-time bump, and then we'll hopefully get back to some sort of increases as October rail car loads in the motor vehicle category rose about 15% month on month, but we've seen that come down a bit again as things have normalized a touch. Then when you look at the expenditure side, shockingly, they continue to go up, which measures the total amount spent on freight, rose to a new record level of 3.96, up 37% year over year in October. This index reaccelerated from 32% growth in September. And on a seasonally adjusted basis, expenditures rose 3.9% in October, mostly due to higher shipment volumes and to a lesser degree from higher rates. So again, volumes continue to go up. Rates have stabilized a bit, but you have diesel still going up. Still the shortfall on wages, which is why long haul still remains an underlying problem. On a 2-year stacked basis, the Cass expenditures index was up 41% in October, explained by higher rates and shipper volumes. If normal seasonality were to play out for the rest of this year, the full year increase in this index would be 34% in 2021, after a 7% decline in 2020 and no change in 2019. Tougher comps in the coming months will come, but again, you still have those numbers still coming through. Then when you look at number of vessels waiting in San Pedro Bay, they still remain at near all-time highs as wait times continue to expand. They are getting a little bit better, but again, it's more because of seasonality and less because we've caught up. There's that usual slowdown that goes into Thanksgiving, and it's just a matter of how quickly can we see some of this ramp up as the vessels continue to sit and wait for the offload. And then when we look at North America rail, the one thing that we were hoping to see a bigger rebound in was intermodal. You've still seen an increase in intermodal. It's just there's still those issues when you're looking at the ability to move product based on the lack of labor, and that continues to be an overhang, especially when you're looking at the rail side. Then when we look at after goods clear U.S. sports, the inland delivery remains that choke point. And I don't really think could be. I think it is when you look at truck stop market demand, which again, we talk about every week on the EIA show. You haven't seen that really increase, and it's because there's a difficulty of what are the hourly rates, what is diesel, and what does that long haul look like, which is creating some of the strife because people want higher wages. And right now there isn't that money, but as costs come down on the cost of the container and the cost of the shipper, shipping, when we're thinking about coming across the ocean, there could be some additional cash to then get allocated or reallocated to the internal side, which might help alleviate some of this. But again, you're going to take time to see some of those shifts coming through. Then when we look at industrial production, stronger industrial production in October, up 1.6% versus the estimate of 0.9 and 1.3% in the prior month. Factory production was up 1.2%, utilities was up 1.2%, and mining up 4.1%. Mining, again, creating this nice little bounce. But this is also a matter of how much have we seen caught up. Supply issues still remain a problem. Inventories have started to get drawn down again a bit, and that's going to create additional struggle in terms of what production continue to run up to, given that they had some inventories come through, start to work through it, again, trying to create some of this buffer into the holiday season. Now, on the other side, when we look at what is happening in the U.S. Empire State Manufacturing, New York Fed's Empire Manufacturing Index was stronger in November, despite the 6-month outlook dropping sharply. The level for now is still in expansionary territory and higher than where it was in 2020. So the current backdrop in terms of general business conditions still remains strong. Things look okay, but then people start to get concerned going forward based on wages going up, prices going up, and how do you manage the increase in cost and that pass-through of wages? And here are some of those leading indicators. So the U.S. Empire Manufacturing number of employees going to a new record going back to 2005, which is, again, going to result in more CapEx because you have to pay your employees, not only just the number of employees, but you're getting more of them. You have to pay them more given where the current normal wages are. All the while, expected shipments are coming down. Delivery times are getting better, but again, we don't expect this to be a huge drop, just more of a peak like we had previously, and then you go sideways as you work through some of the additional issues that are still remain throughout the supply chain. All the while, prices paid moved back to to all-time highs, while prices received hit all-time highs. So prices paid, the question is, how much can you push this through? So far, that manufacturers have been able to push this through. So far, consumers have been able to take down the increase in price. The question will be, when does that stop? Which is obviously a moving target. Hard to nail down, which is why we look so closely at some of these leading indicators. Then when you look at the manufacturers' expected prices to pay, move back to the highs, while expected prices to receive have moved back to the highs, but not as the high as previously, which is putting some of that pressure onto how much can they actually recover some of these underlying costs. And then when you look at what the New York Fed is saying, so when you look at prices paid back to the all-time highs from 2008, and then when you look at prices received back to the all-time highs again from 2008. So these are some of the underlying issues. And then when you look at, obviously, against 2008, that's when you start to get the question of, well, do we have a stagflationary backdrop going forward or a deflationary backdrop? Because again, the pace of inflation is going to level off. So the question is, does it level off into a deflationary backdrop, or do we start to see this sticky stagflation? And if you look at where wages are projected to be and where prices are projected to be, it's more of a stagflation, because you have companies that are sitting on record low inventory, so they're buying inventory at record high prices. So they're going to try to not write down that inventory, which is also why they're not in any hurry to speed it up, because they want to try to manage that price. But that's going to keep the end price elevated for the consumer, giving way to more stagflation versus deflation, that will follow in the Q3, Q4 of next year. And then that's when you start looking at current wages, again, still staying at all-time highs, and future wages breaking to all-time highs in terms of what is viewed. And that's when inflation and wages have this cycle effect, where as wages go up, prices go up. And then as prices go up, living costs go up. So then wages have to go up. And you get an idea of how you get into this circle. And it's really, the key is, how do you break out of this never-ending merry-go-round? And the issue, the way, is raising rates. So then when we look at what does that mean for family rents and what does that look for inflation, well, single family rent index year over year, percent change by price tier, highest ever across all tiers. Single family rent index year over year, you can see, is up 25%. Miami had the biggest year over year rent price increase in September. So again, as we've said, wages and rent are still at the early stages of getting priced in. All the while, consumer price index continues to drift higher across all metrics: median, trimmed, CPI, core CPI. All of this is going up, creating that stickiness that we've been talking about so aggressively, and why it's so important when we're looking at sticky versus core versus trimmed. They're all being pulled up. And because of food, because of rent, because of wages, all of that is, again, going to keep this not so much going up at the same pace, but as it levels off, it'll level off into a stagflationary standpoint, not so much that deflationary standpoint, which is then when you start looking at that jump in core inflation is not just a direct COVID hit. It is not just a direct COVID hit, because when you look at that COVID sensitive components, they've really started to level off as that core continues to surge. And this is just giving you an idea of where that 2% is and where we currently sit when we're looking at the natural trend of that core CPI index. All the while, annual inflation, while it is up everywhere, it is up the most in areas that have the best living wage or the best living expense, but it's also the furthest from the coast, which means that it costs more to get to, as we're importing at a record level and have to move that into the center of the country. When this is then when you start factoring that in with the New York Fed underlying inflation gauge, it's at the highest level going back to 1996. And that's when we start looking at price stickiness, where what makes a price sticky? And the answer is really what the people have tried to come up with some sort of view of. And the prevailing belief is that in some markets, changing prices can involve significant costs. These costs can greatly reduce the incentive of firms to change prices. So when they do change prices, it's very difficult to get them undo those price increases. While a sticky price may not be as responsive to economic conditions as flexible, it may do a better job of incorporating inflation expectations. Since price setters understand that it will be costly to change prices, they will want their price decisions to account for inflation over the periods between their infrequent price changes. So again, using that information, they've come up with a way of 45 categories derived from the raw price data into their sticky price and flexible price aggregates in order to get an idea of where is that stickiness, which is why I've been saying that flexible remaining so elevated is now pulling that sticky side, and you're not going to see the sticky inflation really go anywhere. And then when we start rounding that out and look at supply disruptions versus core CPI, here you can see that supply disruptions have started to normalize a bit. So you will start to get a little bit of that capping in core CPI inflation. There's still some of that upward momentum because even though supply disruptions are getting better, that's giving way to more increases in wages and wage cost, which is going to, again, keep core CPI elevated, but at a slowing underlying rate. And then, but with that being said, the biggest mismatch right now is the adjusted retail and food service sale total. So you can see that sales continue to go elevated on a nominal level, while buying conditions for large household durable goods is at the lowest level ever. And then factoring that in, University of Michigan expected change in financial situations in a year is coming to the lowest point that we've been at since 2011. And based on the going back to 2022, it's the worst buying condition for large household durables. And if you go past 2022, worst ever. So now when you look at University of Michigan buying conditions for a house, it's the worst since 1983. And then when we round that out and look at the University of Michigan buying conditions for vehicles, it is the worst ever. So again, you see a lot of these pressure points, a lot of these issues that remain, which is why when we start looking at those leading indicators of how people are spending, their goal is to let prices come down a bit. But you only have so much, because what is the storage capacity or inventory at the consumer, at the manufacturer, at the end user, at the wholesaler? And that's where people are trying to maintain like almost at time spending to not lock in an excessive amount of inventory at these elevated prices. So now in the next segment, we're going to go more into wages and retail sales and try to look at how those are correlated and how that's going to shake out over the next few months.